Most people agree that Warren Buffett is the best investor of all time. He continues to lead Berkshire Hathaway as a chairman and CEO at 92. Buffett increased the value of the stock at a compound yearly return of 20.1% since taking over the business in 1965. For example, that is over twice as much as the S&P 500's 10.5 annual total return over the same time. The difference might not seem significant until you consider the impact of compounding over time. To put that into perspective, each $1,000 invested in Berkshire would have generated $36.4 million. The S&P 500 would have returned $302,000 for every $1,000 invested. That variation is significant. What is Buffett's secret then? The main strength of Warren Buffett is this grasp of value investing at its core. He is aware that equities represent an ownership interest in a legitimate corporation, not merely prices and charts. Therefore, while investing, you must approach it as a business owner. Buffett has achieved great success by investing in and hanging on to profitable long-term firms. These are true cash-flowing companies with large economic moats. Buffett then reinvests and buys shares in one more successful companies using the earnings and dividend payments. Over time, this has a substantial compounding effect. Although Berkshire Hathaway, the corporation owned by Buffett, does not distribute dividends, it undoubtedly enjoys getting them. Their public stock holdings are projected to generate more than $6 billion in dividend payments in 2022. That amounts to $6 billion in a single year. In addition, the BNSF Railroad, Gecko, See's Candies, Nebraska Furniture Mart, and other owned companies also contribute to their operating income. In today's video, I'll analyze Warren Buffett's current dividends and explain how important they play in his remarkable success as an investor. But before that, welcome back to this channel. This is Jules, and if you are new to this channel, don't forget to subscribe and hit the notification bell for more upcoming videos like this. You could feel discouraged about investing after currencies like the 2022 stock market meltdown. The media is filled with unfavorable emotions everywhere you turn. But now is not the time to let your long-term objectives slip your mind. So as we refocus our community on some basic investing ideas, I'm making this video today. Warren Buffett is the best person to help with it. Value investing is a term used to describe Warren Buffett. Using this strategy, you try to purchase stocks trading below their true value. It appears straightforward, but there's a lot more to it. Even the legendary Warren Buffett has noticed substantial changes in his investing approach over time. He transitioned from trading what he referred to as used cigar bunch to owning quality companies for the long haul.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, say, in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar. One puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business and you keep making more money.
His investing partner, Charlie Munger, significantly impacted his decision to shift his attention to the quality of the underlying firm. Their investment in See's Candies taught them the most about the value of quality.
But we both kept learning all the time, so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson, and it'll teach you a lesson if I tell you the full story. If See's Candy had asked $100,000 more, Warren and I would have walked. That's how dumb we were at that time.
10,000 more.
And one of the reasons we didn't walk is while we were making this wonderful decision, we weren't going to pay a dime more. Ira Marshall said to us, "You guys are crazy. There's some things you should pay up for. you're underestimating quality. Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind. And that is a very good lesson for anyone. The ability to take criticism constructively is well, think of all the money we made from accepting that one criticism. And if you count the indirect effects from what we learned from buying Seas, you can say that Berkshire's been built partly by learning from criticism.
I'll explain now why leaving Seas Candy would have been a poor decision. To know more, make sure to finish this video. And before we continue, if you want to support this channel more, you might want to try our program or to try our super thanks, wherein your comments will be highlighted. For $25 million, Berkshire Hathaway acquired to enter business in 1972. That year, the company generated $31 million in sales and after earnings of $2.83 million. In addition, the company required $8 million in working capital to operate. Buffett valued the waters at $25 million, thus he was unwilling to pay more. That would have proved to be a stupid decision. As of 2007, Seas Candies had generated pre-tax profits for Berkshire Hathaway of $1.35 billion. Additionally, Seas generated a pre-tax profit of approximately $82 million that year on $383 million in sales. As a result, Buffett has more than tripled his initial investment and continues to Seas Candy. Based on this, it made no difference whether they paid $100,000, $1 million, or dang it, even $10 million more. Since then, it's just gotten better. In 2019, Buffett claimed that Seas had generated well over $2 billion in pre-tax profits and that Berkshire Hathaway Chocolate Company continued to be cash cow. Seas Candies is an excellent example of qualities Buffett values in a company. The company has developed a competitive advantage through a strong brand and customers' loyalty. Buffett states, "We seek a business with a long-term competitive advantage in a stable industry. If that comes with rapid organic growth, great. But if such a business is rewarding even without organic growth, we will simply take the lush earnings out of business and use them to buy similar businesses elsewhere." He accomplished this precisely with Seas Candy, a business with little room for growth but steady cash flow. Buffett's subsequent investment would reflect this philosophy of making excellent purchases at reasonable cost. Some of you might wonder what this does with dividend stocks. Seas Candies is fundamentally a dividend stock. Just that Berkshire owns the business outright, almost all of the profits are distributed to Buffett so he may reinvest in new companies.
Seas Candy has paid everything virtually out to us that they've earned because they do not have the ability within Seas Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for Seas Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If Seas Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire.
Although most of his holdings pay dividends, Warren Buffett does not specifically target dividend equities. This association is caused by the kinds of companies he targets. Companies with dividend stocks are frequently established, mature, have successful business models. This closely aligns with Buffett's preferred investment strategies. As I have indicated, Berkshire Hathaway is on track to receive $6.07 billion in dividend income from its holdings of publicly traded stocks over the upcoming year. Only 5 of those holdings will be responsible for 71% of the dividend. The company that pays Buffett most dividends is recent addition Chevron. He acquired 163.53 million shares in 2022, giving him 8.4% of the business. In addition, he receives a prospective annual dividend of $5.68 from Chevron, which pays a quarterly dividend of 1.42 cents per share. This results in Buffett's total annual dividend income of $928.86 million. You may disagree with me, but I wouldn't mind at all. Additionally, Chevron has increased its dividend payout over time and is likely to do so soon. This will raise his payments even more in the future. The recent dividend increase for Chevron was 5.97. Chevron appears to be on track to become Buffett's first dividend of $1 billion. This is a new addition to his portfolio, as I have indicated. How much does he cost then? The first quarter of 2022 saw the majority of Berkshire Chevron purchases. His estimated per share cost basis is 146.56 cents, according to WalesWisdom.com. This results in a 3.88% dividend yield on cost for him. Buffett has sold energy stocks after a few years, but he has never held a stake in size. He also purchased another oil and gas stock, which we will discuss briefly. Only time will tell if it turns out to be another long-term holdings for Berkshire. Bank of America is its second largest dividend payer. He bought his stocks in 2011 at roughly an average price of $14 per share. He has more than 1 million shares, or 12.9% of the corporation. The quarterly dividend payment from Bank of America was just boosted by 4.76%, bringing the yearly payout to 88 cents per share. Over the upcoming year, Berkshire Hathaway will receive dividend from Bank of America totaling $908.9 million. This places the dividend yield on the cost of its third largest payer, Occidental Petroleum, around 6.28%. He has a long-term history with Occidental, but in 2022, he made his biggest gamble too far. At this time, Berkshire owns 188.36 million shares, or 20.2% of the firm. Following the 2020 oil crisis, Occidental cuts its dividend distribution and is gradually raising it again. At this low level, Berkshire will only receive $98 million in dividend payments the next year. However, this will undoubtedly expand in the future. Additionally, due to the company's history of paying out preferred dividends totaling additional $800 million, Berkshire owns $10 million in preferred stock. This values the annual dividend income of Western at $897.95 million. Apple ranks fourth on the list. Berkshire Hathaway now owns more than 5.7% of Apple after Warren Buffett's significant investment in the company in 2016. Although he has already realized a sizable return on his investment, I believe this stock has the potential to become his next great dividend growth pick. He expects to get dividends worth $842 million this year. With an estimated cost basis of $34.26 per share, he has a 2.68 dividend return on cost. Apple has a huge following of customers and is currently the most valuable brand in the world. Furthermore, it has a sizable program for stock repurchases and has been raising the dividend for over 9 years. If, after 30 years, Buffett doubled his initial investment every 2 years through dividends akin to his investment in Coca-Cola, I wouldn't be surprised. Referring to Coca-Cola ranks 5th on the list. Since 1988, Buffett has controlled the Coca-Cola company. This feeds the Candies model and is one of the best instances of long-term investing. In addition, he will receive dividend income from that investment totaling more than $704 million this year. With a current dividend yield on cost of 54.2%, Buffett has initial cost basis of 3.24 cents per share. This indicates that he is generating enough dividends to double his initial investment every 2 years. For more than 59 years, Coca-Cola has steadily increased its dividend, and there are currently no signs that this trend will reverse soon. This is a perfect example of a long-term investment in a company with significant competitive advantages. Over 71% of his $6 billion in projected dividend income comes from these 5 stocks. Along with Coca-Cola, several other long-term holdings such as Moody's and American Express have outstanding dividend yields on cost, but this is only his portfolio of publicly traded stocks. Additionally, Berkshire Hathaway has a sizable portfolio of wholly owned companies. Buffett reinvests the earnings from fully owned companies in dividends to purchase new profitable businesses. This feeds Berkshire Hathaway's compounding engine. When you continuously reinvest to boost your earnings potential, that is a great way to generate money. Because of its commitment to reinvest profits, Berkshire Hathaway does not distribute dividends. And that's it. Let me know what you think in the comment section down below. Thank you for watching. Again, this is Jules, and don't forget to like, subscribe, and hit the notification bell for more upcoming videos. But before you leave, did you know that there is the best fidelity index fund that you could buy? Well, to know what these are, click and watch this video here. See you there!